Securities. From there, I went to William Blair and Company. It's one of my clients that hired me and to run a new fixed income arbitrage department. From there, they had limited capital, so we started raising new capital under a new firm, which was my own firm, which was ABM Securities and III Investments, and that was 1982. And that firm is still alive and well in West Palm Beach. I ran the funds there until 1997, after which I turned them over to my partners after 15 years to do other things. I got an honorary PhD from Franklin University, so that was nice. But and I've written numerous papers that have been published in academic journals. The most recent was in the mainstream journal, Maximizing Price Stability in a Monetary Economy, which in the Journal of Policy Models, which is like the #2 mainstream journal in the world. So I don't think you can rightfully call it heterodox economics anymore. I think it's rightfully mainstream. It's in a peer-reviewed leading mainstream journal. And that was a proposal for the European Central Bank to fund a job guarantee for all its members to promote its single mandate of price stability, to better control the price level, which is its single mandate. And I did that with Damiano Silippo, Professor Silippo of Calabria back in 2017. And so anyway, I've met with central bankers, people from Treasury, people all over the world. I've got a short online book that goes into the history of it. It's called The 7 Deadly Innocent Frauds of Economic Policy. It's free online on my website, which is moslereconomics.com. And you can catch up on all the history. But I have to say, I've met a lot of people, a lot of central bankers. I've met with Ben Bernanke and Janet Yellen, and more importantly, their senior staff were far more understanding of monetary rate operations than any of the political appointees. And I've been doing this for 30 years now. The first writings came out in 1992, and there hasn't been a single word refuted in that entire time. And this whole movement has grown by word of mouth, by reading, but it started as one person, then it became 2, and then it became 4, and then 8 over the years until today it's probably in the millions. So it's been a grassroots movement. There's been no one with what we call Ivy League academic credentials. There's been no one with senior political credentials. There's been no major funding. There have been a few $1,000s here and there with funding that received for scholarships for grad students. No major funding, and it's taken over. And I would say it's changed the world for the better. The United States just increased the budget deficit to $3 trillion, and the talk is another $2 trillion, which is more deficit spending on a per capita basis in World War II, without a single discussion of a tax increase, something that never would have happened even a year ago, I don't think. So in that sense, you have to credit MMT is saving the world, because this is happening all over. Look what the European Central Bank's done by allowing the deficit spending they've done. Would they have done that a year ago, before you heard mention of modern monetary theory from the European Central Bank and European Parliament and everywhere else, and particularly all the Italian activists? I don't think so. So is that a sufficient introduction? Okay. So now start the presentation.
Yes.
So, okay, so we're ready to go. Now I've got all your pictures across the top. I can't read my top line. Okay, so let's get this all the way over here. Okay. So let's look at what is government. We'll start from the beginning. Government is collective action. Government is public infrastructure for public purpose, which you call the common weal, I believe. And let me give you the most basic notion of government. You're at a football game, and if you stand up, you can see better. But if you stand up, if you stand up, then other people can't see, so then everybody has to stand up. If everybody stands up, to watch. Nobody sees better, and nobody can sit down. So you're all worse off. So the answer to that situation is collective action. You have a stadium has a rule, you can only stand up for 10 seconds, 15 seconds, and then you have to sit down. Okay, that's what I use as a fundamental example that I think everybody agrees on, that there are times when collective action is better than individual action, and that is another word for government. It's not all times. You can have bad collective action, you can have bad government, but there's certainly a fundamental need to stop what are called races to the bottom. This idea with the football game is called a race to the bottom. One person stands up, everybody's worse off. Other races to the bottom happen when you don't have standard pollution control environmental laws. In the United States, it was left up to the individual states for a long time. And so the state that allowed the most environmental destruction would attract the most business. And so it was a race to the bottom. The states got laxer and laxer with their environmental regulation until rivers started catching fire, and it was determined there's a federal need for collective action here for environmental regulation. Okay, so government, I see, is primary mission is to stop these races to the bottom and provide collective action where it makes sense, such as common defense, legal system, and other forms of public infrastructure that serve public purpose, the common weal. Okay. Modern monetary theory, what is it? So the easiest way to start is that we tell the money story differently from all the other economists, all the textbooks. You'll get a variety of introductions to what money is. They'll talk about somebody on a desert island, and then there's two people and they barter, and then it becomes easier to use money, or people living in a farming community barter, trading grains and animals with each other, but then it becomes more convenient to barter rather than cut up animals into pieces to make transactions with them. You know, I'm not saying that didn't happen, but it's not relevant to what we have today. Today we have state currencies, and they begin with our money story, with a different money story. And the money story begins with a state like Scotland, that went independent, that desires to provision itself. Well, what does that mean? Well, the new government's going to need public health, it's going to need a legal system, it's going to need public education, it's going to need all kinds of public services to function. Well, how do you get people to get out of the private sector into the public sector? Okay, that's what we talk about, the state provisioning itself. And the way it's done right now in the world is the state imposes tax liabilities payable in its currency, which becomes the tax credit, the thing to use to pay taxes. Okay, so number one, you have to impose tax liabilities. Now, number one is not that you actually collect taxes to spend, as everyone in the US Congress believes, or everyone in the Parliament in the UK believes. You don't. Okay, you impose tax liabilities first, payable in the currency. Okay. These tax liabilities result in sellers of goods and services, people like yourselves, seeking the state's currency in exchange. Now, people are going to need those, be willing to work to earn those tax credits, the currency, the pounds, because they either need to pay taxes, or they want to buy something from someone who needs to pay taxes, or they want to buy from someone who's going to buy something from somebody else who, at the end of the chain, needs to pay taxes. It's not an infinite regression like the textbook money story. This is anchored to the need to pay taxes. And it's absolutely replicable in a room full of people, at any time. So for modern monetary theory, that's what drives the currency. So the resulting sellers of goods and services looking for the state's currency, we call that unemployment. Right? Unemployment is defined as people looking for paid work, not people looking to volunteer for the Heart Association. And so, what taxes do is they cause unemployment, people looking for paid work, for the further purpose of the state then making its desired purchases. In other words, the state then hires them. Okay, so the state wants people working for it. It imposes tax liabilities. This causes people to look for paid work. The state then hires them with its otherwise worthless currency. And only after that are taxes paid, because the currency wasn't, the money wasn't there before, the tax credits weren't there before. Okay, so we talked about unemployment a little bit. It's the evidence that the state has not hired all the unemployed who were made to be unemployed by the tax liability. There's no other way to make a population unemployed, which means looking for paid work in that currency, than a tax liability. And a given tax liability will create a certain number of unemployed, presumably because the state wants to hire those unemployed. Well, if it creates 1 million unemployed, it only wants to hire 500,000. The other half remain unemployed until something changes. If the state doesn't, and another way to say that is if the state doesn't spend enough to cover the need to pay taxes and the desire to net save, because savings can only come from the state. It's the source of the currency. The evidence is unemployment. Okay. Now, let me just quickly get into the job guarantee, because there are questions about that, and I think we'll just use this to set them aside right away. Okay, so what I say is, look, the government should either hire the unemployed it created or transition them back to private sector jobs. Why would you put a tax on everybody's house, create unemployment, then not pay them enough to pay the tax and then go burn their house down as a penalty? I mean, that doesn't make any sense. So you've got a tax that has created a certain number of unemployed, either hire them or transition them back to the private sector. The problem is the private sector doesn't like to hire the unemployed. Okay, it considers them stigmatized because they've been out of work. They've may have lost their work habits. They may be on drugs. They may get into fights. They may not clean it. They don't know. So the private sector generally doesn't like to hire people who are unemployed. But the state doesn't want them to remain unemployed. It wants them back in the private sector. Now, this is after the state has properly provisioned itself with all the public employees it wants. Okay, you put a tax in place, you create unemployment, you hire all the people you want to fully provision the state, and the rest, you want them working and productive, get them back in the private sector. Well, the private sector doesn't want them as they are. So offering a job to anyone willing and able to work, by the state offering a job to anyone able to work, facilitates the transition from unemployment back to private sector jobs, because once they're working, the private sector, they then become attractive to the private sector when they look to hire additional people. Okay, and all this is fully documented. This was actually done in Argentina in 2001, and they had 2 million people show up for this public sector job guarantee, and full 1 million of them transitioned back into the private sector within 2 years. And the people who showed up for jobs were people that no one expected ever to get a private sector job. So there's no dispute that this works. So that's what the job guarantee is, if anybody asks about it. Okay. A job guarantee policy enhances price stability. You have less inflation with a job guarantee than without it. It's a superior price anchor. Why? Because in today's economy, we use unemployment as our buffer stock. Marx's army of the unemployed. That's how we control wages and prices in the economy, by keeping unemployment at a high enough level to keep employers from being able to, needing to raise wages to keep employees. They have all these unemployed they can hire. However, it doesn't work as advertised, because the employers don't like to hire the unemployed. So you see with each cycle, the unemployment kind of cycles higher and higher, the base levels each time, to where now they consider, 9 or 10% unemployment the minimum in the European Union, because below that you'll get inflation. Okay, that number used to be much lower, but because long-term unemployment particularly are unattractive to the employers, they can have labor shortages even with 10% unemployed. Now with the job guarantee, suddenly these unemployed who are now working every day, they have a track record, they come in, they have a supervisor who will tell you they don't get in fights, they're clean, they get along well with people, they become far more employable, and then they can much more easily transition into the private sector. The economy can grow much more quickly, because growth is based on how many people you have, the increase in the number of people working plus your productivity. So the number of people working is your prime determinant of your output, your GDP, in any given year. And so it enhances the price stability. You're less likely to have labor shortages and price increases because of bottlenecks and labor shortages. Okay, so I'm now going to interject the story of Pompeii because it tells you a couple of things. It tells you one thing is that what I'm saying, people have known for a very long time, and it's knowledge that's been forgotten. It's not some kind of mysterious knowledge. This was things people knew for thousands of years, and it's just been forgotten in the last 100 years or so. Okay, so my wife and I were visiting Pompeii, and I think that might be us on the left somewhere. No, I don't know. We jumped on a little tour. And the tour guide was showing us around, and he showed us these coins over on the right, and said they found these coins in the ashes, from 2,000 years ago. And Pompeii was a very nice place to live. It was like a suburb of Rome. Not in Rome, it was maybe, I don't know how many miles away, 50 or something, which I guess back then was a lot more than it is today. But it was a very nice place to live because even though taxes were high, their public services were very good. They had good public safety and sanitation, all those things people wanted to have a nice place to live. And he said the way it worked was they would collect these coins for taxes. And if you notice the coins, they weren't silver or gold. They were just bronze or copper, some inexpensive now. But they would collect these coins for taxes, and then they would pay the public for public service workers, to be police officers or sanitation or whatever. And I'm a little bit of a troublemaker, so I said to the guide, I said, well, no. What they did was they paid the people first, and then the coins were used to pay taxes. And he goes to me, no. You collect taxes and then you pay the people. So I said, well, where did the coins come from? He said, well, the government made them. I said, well, how did anybody get a coin to pay the tax? And he said, so they would pay the people first and then collect the tax? I say, yeah, how else could it work? And he goes, grabs his head and he goes, no. And he ran away. He wouldn't talk to me for the rest of the tour. Okay, so look, everybody in Pompeii knew the money story. They knew the city would impose a tax on all their houses or whatever. Maybe it was on their heads, I don't know. Let's say a real tax on their homes in these coins. And then that caused people to show up to work to earn the coins, and they were paid more than enough, so everybody didn't have to go work for the government. Then they could take these coins and buy pizzas and buy other goods and services from the remaining people in the town, the tradesmen and everything else, would sell their wares to them, and then they would have their coins to pay the tax. Okay, and so everybody knew the sequence. First was a tax liability, then came people looking for work, then they got paid, and then the taxes were collected. And so there are some lessons from Pompeii that carry over to today's national currencies, such as British pounds. The funds to pay taxes and buy securities come only from the state and its agents. And I can trace that through the accounts of the central bank if you want, but I'm not going to do that right now. Okay, but they do. Otherwise, it's what's called counterfeit. Counterfeiting is against the law in every country in the world. For that reason, the funds to pay taxes can come only from the state. Okay. Therefore, from inception, the state has to spend first, and only then can taxes be paid and state securities purchased. Okay, so this means solvency and crowding out concerns are inapplicable. How can you worry about whether a government can make its payments when it has to spend first and then collect tax? Then you can buy bonds from the government if it wants to sell them. So the Bank of England is crediting accounts first with pounds, and then those pounds are used to either pay taxes or buy bonds. And when they buy bonds, they're just shifted to another account called the gilt account, I believe, or securities account, also at the Bank of England. So they're just spending first, crediting an account, and then either debiting the account for tax payments, making it smaller, and what's left over is used, shifts into a securities account. Okay, how can you crowd out borrowing if you're spending first and then borrowing your own currency back? You can't. Okay, it's an entirely inapplicable concept. And that's why there's never been a problem. I think England, the UK was just downgraded because they're questionable public finances. So what does that mean? They're not, the Bank of England's not going to be able to credit an account to make a payment? Like, why not? What, are they going to get an electric shock or something when they put the money in? And of course they can. They can credit an account anytime they want. There is no solvency issue. They can create other problems with their spending, lots of other problems, and they do, but they certainly don't have a solvency problem. And there's never, ever, and there can't be a crowding out problem. It's just not applicable. Okay, well, everybody in Pompeii knew that. Okay. The currency is a public monopoly. The state pays prices, the state pays create the price level. So what does that mean? So let's look at that coin in Pompeii, and I'm going to ask you, what was it worth? What would a coin buy? Okay, well, it would buy whatever the state said it could buy. And the way they would do it is was based on what they paid the people. So if they paid the people 1 coin a day, the coin became worth, through market forces, 1 day's labor as a police officer. So the person selling pizzas had the choice. You could go work as a police officer and earn a coin. Maybe they needed 5 coins a month to pay their taxes. I don't know. This police officer is going to earn 30 coins, and he'd had 5 for his taxes and 25 to buy the rest of the things he needed. You could be a police officer, make 1 coin a day, or you could make pizzas and sell pizzas for the coin. So he had that trade-off. So he needed to get a high enough price for his pizzas, or he was going to go be a police officer. And if the price was too low, and if the price was too high, other people would not be police officers, they'd be pizza makers, and the markets would settle on some ratio. And so let's say 1 coin would be worth 10 pizzas, just for a number. I don't know what it would be. And that would stay like that as long as the state was paying 1 coin a day to the public service workers. Now, if suddenly relative value could change, if wheat became scarce or something like that, the price could go up, go down, if other costs were involved. But all else equal, the price would stay there indefinitely. Now, let's say the state Pompeii decided to pay the workers 2 coins a day instead of 1. Now what happens to how many pizzas could it buy? Okay, now a coin could only buy 5 pizzas. It's only worth half as much. Instead of a pizza being worth 10 cents, where you could buy 10 with a coin, it was worth 20 cents, where a coin could only buy 5 pizzas. Why? Because it only took half a day's work to earn the coin from the state instead of a full day, right? So a monopolist is always price setting. There is no natural market for Pompeii's coin. They have to decide what to pay the people who work for them, and that gets translated through market forces into what everything else costs. And in a market economy, that's called setting one price. The monopolist sets one price, and everything else reflects what they call relative value, indifference levels. And that's just standard mainstream economics. I'm not telling you anything different. In fact, in micro, you learn about monopoly the first day. It takes about 15 minutes. It's very simple. Then they go into oligopoly. That takes a few days. Then they go into competition, which takes the rest of your life if you ever get there. You have to learn what an asymptote is, and math, and all that stuff. The good news with the currency is it's the easy one. It's monopoly. Okay, so the price level is a function of prices paid by the state when it spends. So no other school of thought understands where the price level comes from right now. Everyone in Pompeii understood it. Everyone in Africa understood it when the Brits went in there and put a hut tax in everybody's house in a new currency and told them to earn it, they have to come down to the plantation and get paid, in this new script. They all understood where the price level came from. It came from the British telling them what the price level was to tax they needed to pay by working in the coffee fields to keep their hut from getting burned down. Okay, but it's been lost. Today, there's all these theories of the price level and inflation, and not one of them centers on the actual dynamics behind the state currency, which is prices paid. Okay, the only way you're going to get prices rising continuously, in actual fact, is for the state to continuously pay higher prices. That's what caused prices to increase continually. That's what causes what we call inflation. It's not the academic definition of inflation, discussed later, but it is what we call inflation. You never hear that. You'll hear overspending, you'll hear all kinds of things, you'll hear it's the state paying a higher price, paying 2 coins a day instead of 1. That's the cause of inflation. And they'll pay 4 the next day and 8 the next day, and the currency is continuously buying less and less and less. That is the only cause of the price level. It's a point of logic. There can't be any dispute to that. It doesn't mean every price everywhere works according to that, works like that. I didn't say that. I'm saying the underlying force behind it is the price the state demands in exchange for what nobody has. It has it, we need it. It tells us what we have to do to get it. In the old days, they used to call a place like Pompeii or under Edward the Great, they would call it crying down the currency when the king decides to pay more for the same thing. He said, inflated his currency. Everybody knew about this. Okay. The policy interest rate is set by the state. Everybody knows the central banks vote on the interest rate. There's big news about what the next central bank vote is going to be. It's not what the market's going to make them do, it's what they're going to vote on. And the last one I'm not going to discuss at all except mention it, which is an MMT contribution. The term structure of prices is a function of the policy interest rate. This is inflation as academically defined. And I'm just going to skip over. If somebody wants to talk about it later, I will. It's not relevant. So let's talk about the public debt. So these archaeologists in Pompeii, last I read, they found something like 20,000 of these coins in the street. So how did they get in the street? Right? Well, somebody must have gotten paid, and they found them in what would have been, when I say in the street, it would have been somebody's pocket, it was in the ashes. It would have been a cash register of some sort, would have been under somebody's mattress. These were the money supply of Pompeii. The coins in the street. Let's call it the money supply of Pompeii. The net money supply. They had credit and all those things, but the net money supply underneath the coins, there were 20,000. Well, these must have been coins that the government spent. Some of what they spent were used to pay taxes, some were not. The people earned more than they needed to pay taxes because they wanted coins in their pocket. The merchants wanted cash in a cash register, which hadn't been invented yet, but they had something to make the exchange. And people wanted coins in their mattress for savings of some kind. And so the only way they could get those was there was a demand for those. They were readily available. Just go to work for the government. They'll hire you. They don't care if their expenditures were higher than what they collected in taxes. They always ran a deficit. They always spent more than they collected. They had to. They couldn't collect any less than they spent as a point of logic. I'm sorry, they couldn't have collected any more than they spent as a point of logic. They couldn't have spent 1,000 and collected 2,000. Where did they come from? They all came from the state. So maybe over the years they spent 100,000 coins, 80,000 were used to pay taxes, and the other 20,000 were in the street, the money supply. That today we call that the public debt. The public debt equals the funds spent by the state that haven't yet been used to pay taxes. Okay, and the public debt already is the money. So paying it back is entirely inapplicable. If you went to Pompeii and people had 20,000 coins and you looked at the books of the government and they had spent 100,000 and only collected 80,000, you wouldn't ask, geez, how are you going to pay that back? Nobody would look at you like, what do you mean? It's not applicable to what's going on. That's the extra coins spent because people wanted them. It's the money supply. So today, the UK government spent how many trillion pounds. They credited them to accounts at the Bank of England called reserve accounts. They debited some for payment of taxes, which reduced the balance. The rest were shifted to securities accounts called gilts and whatnot, and that equals the public debt. And some people wanted actual cash, so some of those reserves were shifted to cash, which is just pounds written on a piece of paper instead of on a bank statement. Okay, what are those cash reserves and securities that are still there right now? Those are equal to the sterling spent by the government that haven't yet been used to pay taxes, and they're in the street. Today, the street is the cash, and bank accounts at the Bank of England. That is the net money supply in the economy, the net financial assets. Paying it back, the question of paying it back is inapplicable. You can ask what happens when the securities accounts, the gilts mature. What do you do? And they say, oh, we debit the securities accounts and credit the reserve accounts. We shift those pounds out of account B and put them back in account A at the central bank. You want to call that paying it back? Fine, but it's not what is normally considered the issue of paying things back. Okay. Scotland's real wealth. What is Scotland's real wealth? What's the real wealth of Pompeii? What's the real wealth of any society? It's the goods and services you produce domestically, okay, plus whatever you bring in, imports, minus whatever you export. Now we say real versus nominal. That doesn't include the money. That didn't include the coins of Pompeii. They're not the real wealth. You can't eat them or do anything like that. They're the tax credits used to provision the government. The real wealth is what was produced domestically in Pompeii, plus what they brought in, minus what they sent out. Think of it as your pile of stuff. Your pile gets bigger when you produce things. It gets even larger when you bring things in, and it gets smaller when you send them out. Okay. Trade. Exports are real economic costs. They're things you send out. Imports are real economic benefits. They're the things you bring in. Imports minus exports are your real terms of trade, and that's what you try to optimize. Now, to these people who think exports are so great, you can look at the extreme example. Well, what would happen if you exported everything? If they're so great, let's export everything. Well, everybody dies. You have no food, you have no clothing, you have nothing, you have no fuel, you all die. All right? Well, what happens if all you do is import? Oh, not only do you die if you export, you're working all day to produce exports. You don't have anything to show for it because you've sent all your output to somebody else. Okay. Well, what if you just import? Well, now you're getting everything from other countries sending it in. You're eating well, you're gaining weight, you've got everything you want, and you don't have to work for it. Okay. In economic terms, that's not so bad. Okay. So what you do is you try and optimize your real terms of trade. The purpose of exports is to be able to import. Exports pay for your imports at the macro level. It's the opposite of religion. Okay, it's economics. In economics, it's better to receive than to give. Okay, so now we're getting into the how much I have. Trying to keep track of time here. What am I at? 2:45. Is that right?
You can go over by 10 minutes. That should be okay. Go over by 10 minutes or so. So don't worry about it.
Am I over already?
No, it's fine. If you go over 10 minutes, that's fine. Just keep going.
Okay. So Scotland goes independent. What are your options? Okay, one is to use sterling. And if you use sterling, you then become like a US state or like a European government. You must get the sterling first through taxes or borrowing before you can spend the sterling. That's the sequence if you're using somebody else's currency or if you have a fixed exchange rate. I don't have time to talk about that. But just using somebody else's currency. Okay. Scotland's net sterling financial assets, your coins in the street, can only come from, got net imports here, net exports. That is a typographical error. Okay, so I'm going to have to correct that. You have to export in order to earn sterling to have cash in the street, which means money in your pension funds and everything else. Any net savings for Scotland has to come from net imports. Now, most countries today have net savings of 75% of GDP. You can only get that from net exports. This is annoying me. I want to change it on my. All right, I'll leave it. I'll change it later. Market forces severely limit Scotland's ability to deficit spend. The state can't deficit spend to help the economy. If you look at US states, markets limit that to 10 or 15%. All the European nations with high debt to GDP, 10 to 15% of GDP, with high debt to GDP ratios collapsed because it can't work. They only work now because they have a guarantee from the European Central Bank. The Bank of England is not going to guarantee Scotland's debt. You're going to be limited to 5 or 10% of GDP debt, and maybe less than that. If you look at emerging market countries with foreign denominated debt, they're limited to 5, 10, 20%. Sometimes they get up to 30 through the IMF, but at that point, they're in serious they have serious problems. The markets don't do that. Okay. Market forces can impose severe austerity, high unemployment, until wages are low enough to achieve sufficient imports, until you become the world's slaves and can net export enough to earn your financial assets. Okay, market forces are going to be crushing, and that happens everywhere where you see a nation using a foreign currency as their base currency. Okay. Now, if on the other hand, you use a floating exchange rate currency, your own new currency, then you're in the same position that the UK is now. Then you're spending first, and then taxes are paid. So you're not financially constrained. Okay, you don't have to get the money first. You're just like Pompey was, and just like Alfred the Great was when he ran his society, okay, and just like the Roman Empire was. You're spending first, and then taxes are being paid, just like the United States, Japan, everybody else. Okay, the private sector's net, the coins in the street come from the government's deficit spending. It spends more than it collects. It spends them first. The people pay some back in taxes, and the rest are the financial assets. You don't have to net export to get them. You're not under that crushing restriction of only being able to get financial assets by net financial assets by net export. Full employment, which is critical to optimal real wealth, right? Your domestic output is the largest component of your wealth, can always be continuously sustained. Full employment, unemployment is people looking for paid work. They can always be given work because you spend first and then collect taxes. So they can always be employed and given work, or they can be employed by the private sector and given work. But any extras are there because the tax is too high. You can either reduce the tax and transition it back, or they can be hired by the public sector. So you can always have optimal domestic output. Okay, so how does this actually happen? How do you create your new floating exchange rate currency, which I've called the kilt? If anybody wants to ask me why I named it that, you can do that afterwards. So, so how do you do that? How do you introduce a new currency? It's painfully, pitifully simple. You convert all sterling tax liabilities in Scotland to kilt on a, and I'm saying on a one-to-one basis. You don't have to do one-to-one. The arithmetic, the math, the record keeping is much easier if you do it on a one-to-one basis. And you convert state employee pay to kilt on a one-to-one basis. So if the tax on your house was 1,000 sterling, it's now 1,000 kilt. If you were earning 40,000 sterling a year, you're now earning 40,000 kilt. The deed is done. You have now fully, the government can now fully provision itself through kilt. And that is the whole point. You now have collective action provision through the local currency. It's not revenue constrained. It spends first and then collects. It sets its own interest rate, and it sets its own level of unemployment through its fiscal policy, which is not constrained by revenue, which it would be if you were using sterling. Okay. This also creates an immediate shortage of kilt, to say the least. This would be the biggest short squeeze in history of the world. Suddenly, everybody's tax liability is in kilt, and nobody has it. Now, okay, you've converted employee pay to kilt, but that dribbles out slowly, right? And other liabilities become kilt liabilities also. So now you've created these, the present value of these liabilities is enormous, and it introduces an extreme anxiety of people who want to make sure they have enough to cover their needs. And you have an immediate shortage, and the only source is the new Scottish Central Bank. The kilt is a public monopoly. The kilt to pay taxes come only from the new government of Scotland through its central bank. Okay. So what happens? Well, let's talk about what does not change. Sterling bank deposits are not converted. Now, when the euro switched from all their local currencies to euro, they converted all the bank deposits. The new central bank bought all the bank deposits at the prescribed ratio and paid for them in euro. Suddenly, everybody had euro rather than marks or francs or whatever they had before. Okay, and it created, and sterling debt is not redenominated; it stays sterling debt. In the European Union, all that public sector debt, instead of being in pesetas and lira, suddenly became euro. Okay, and so what happened there is a lot of people got converted who didn't want to be converted. They didn't want the euro. And the euro immediately depreciated from maybe 105 to 85. It was a big 20% until things stabilized and at the new level. So whenever you force conversion, you get people who are converted who don't want to be converted. If you converted all the sterling deposits, probably 2/3 of those people would immediately try to get killed, into kill. Most of those people initially aren't going to want to kill. They're going to be scared to death. And so what they're going to do is sell their kilt to get their sterling back and cause an immediate depreciation. It could be 40 or 50% of the currency. And this invariably happens when any country, converts like that from something like currency, another nation's currency into their own currency, and they convert deposits, they convert the debt. People are not going to want kilt debt, they're going to want sterling debt initially. They're going to sell it to buy sterling. They're going to cause the currency to go down. The currency will go down, the central bank will panic. They don't know how to operate a currency. They'll raise interest rates because of the currency collapse. That'll cause inflation. The currency collapse causes inflation. And then they get in a downward spiral, and the government collapses. You get a military takeover. And it's happened time and time again. And it comes from the source of that is converting these deposits against people's will when you don't have to do it. And this is the first proposal that I've seen in modern day that recognizes that's the source of problems when you convert. Don't do it. You won't have those problems. You'll have the opposite situation. Okay. And government and private contracts are not required to be converted, but they will because of all the kilt liabilities. People will be happy to take them because they'll need them. So we'll talk about the new Central Bank of Scotland. It's a public bank. There's no capital requirement. It's just an accounting entry. It can be positive or negative, it doesn't matter. There are only kilt accounts at the new central bank. Officers are appointed by Parliament. Private banks have kilt accounts at the new central bank for clearing, so they can exchange balances between each other. If you want to move money from one bank to another, if you want to move kilt from one bank to another, they'll do it through a central bank clearing account. To set up the central bank takes about $10,000 worth of hardware and software. It's very simple. It's just a spreadsheet with a few entries. Okay. And state agencies and foreign central banks can also have clearing accounts at the new central bank. They make a whole big deal out of these central banks with huge buildings, guards around them. There's no money in there. Okay. It's just a computer with a spreadsheet. What does the central bank do? They process government and member bank payments, which means they debit and credit accounts of their member banks. Very simple operation. One number goes down, another number goes up. They provide unlimited kilt deposit insurance. That means if you have a deposit at any of the banks, they're fully insured by the central bank. And they regulate the banks to make sure they don't do anything stupid with their money and authority. They provide unlimited kilt bank liquidity to the member banks. What does that mean? You don't need to have an interbank. You don't need to have all these silly markets that they have all over the world, LIBOR and all that kind of thing. It's all created by institutional structure. It doesn't need to be there. You regulate and supervise member banks. Okay, bank solvency and is achieved by regulation. You regulate what you have to do to be eligible to get a loan, and you supervise it to make sure you're not giving loans to the wrong people. And you regulate what collateral becomes viable collateral and what doesn't. So you can't have these Ponzi schemes built up by using financial assets as collateral in the banking system. There's no way any central bank should allow that. You maintain a permanent zero rate policy, just like Pompeii did. Pompeii had all that money in the street. They didn't pay interest on it. It didn't cause inflation. Inflation only came when they changed what they paid for things. They defined it by what they paid. That's the source of inflation. And so there's no interest payments on the money in the street, the public debt. It's just the money spent by the government, the kilt spent, that they're going to spend more than they collect. They're going to sit in bank accounts. They're not going to earn interest. I call paying interest on public debt as basic income for people who already have money. The state's paying out this interest. It's fiscal expenditure, it's deficit spending, and it only goes to people who already have money. basic income for people who already have money. Even the most extreme people who support basic income. I mean, I'm not categorically against basic income, but even its most, strongest supporters, not one of them thinks that you should give basic income only to people who already have money in proportion to how much they have. It's an absurd policy. It shouldn't be done. Okay. Monetary policy, there isn't much. Zero account, interest rates, CBS accounts are not interest bearing. Government spending remains in central bank accounts, no securities, no interest bearing. Unsecured overdrafts replace interbank lending. The deposits are all insured anyway. The solvency and safety comes from regulation, not from trying to use market forces, which doesn't work anyway. Fiscal policy, central bank funds the job guarantee. It's part of the price stability infrastructure, and public services are fully funded to serve public purpose. And because you're going to be at full employment all the time, now you're in a position where you can make sure that you understand efficiency. Job creation is not a desirable goal, okay? If you're at full employment, you've got everybody working productively. If a company wants to move in and it's going to require 10,000 jobs, that's 10,000 people it's going to have to take from people who are already working and shift them to what this new venture is. So you're going to have to make a decision. Do we want these people shifted from what they're doing? Which is more important? So people become important. Everybody is employed. Business is competing for people, and they're valuable. People become valuable, scarce resources. It changes the entire dynamic of the society. College students are being offered jobs years before they graduate because you've got continuous full employment. So you can make sure people get positioned in the most valuable positions. Just wanted to show you, I've heard talk about why your current account is negative. First of all, nobody knows that. And it all changes when you go to Kilt anyway, because the financial dynamics are completely different. But here's the UK's current account. You can see it's been negative and extremely negative for a very long time. And so if you want to go to Stirling instead of Kilt, it's not like it's going to be any different. Okay. And you've got a different set of people mismanaging it where you have very little representation and have not had a good track record of what they've done. He's talking about the currency might be volatile. Here's the pound, got up well over 200, dropped down to almost 100. It's been all over the place, wildly volatile, as has every other major currency. The yen, a few years ago, depreciated 50%, and then came back a little bit. The dollar's been all over. The Australian dollar was 105, and then it went to 50 something. And you didn't hear any big outcry about people about they destroyed the economy or ruined this or that. Okay, what you want to do is maintain domestic price stability, and that's done through fiscal policies we've talked about, recognizing that price is paid by government, which in your case will be the job guaranteed wage, is the main numeraire for the economy. That's how you internally stabilize prices, and then everything else becomes relative value. And the rest of the world's doing the same things with their currencies. They're going to fluctuate all around the Kilt. They can tell you your currency is going up or down, but you know that you've got domestic stability, and sure, it'll have massive, large distributional issues if the price of oil goes up and down, for example. But if you don't, of course you have oil, but for the price of certain imports go up and down. But you're in a far better position to manage. I've got a few footnotes. Narrow banking regulations, like don't lend against financial assets. You direct the production of public service infrastructure to the high unemployment regions. Okay, they built the new European Central Bank in Frankfurt. They should have put it in Athens. Okay, otherwise you're just going to exacerbate the distribution of consumption in Europe in an adverse way. Once you have a monetary union, within that union, you want to have what they are called fiscal transfers, and the way to do that is to direct public infrastructure to the highest unemployment areas. You have strategic buffer stock policies. You're going to want to have your own agricultural buffer stock policies, strategic materials that you might need during all kinds of emergencies. You want to make sure that you have them in supply in the case of emergency. Right now, you can't do that. You have to rely on the UK to do that. Your tax policies can be made a lot more progressive, a lot more equitable, and you can lower your real compliance costs by having the right tax policies, which can increase your real wealth by huge numbers, 10, 15% of GDP. Trade policy, once you recognize that the point is to make your pile larger, that imports are not going to cause unemployment, they're sustained by increasing your domestic unemployment, everybody's valuable. If things can be done with fewer people, that's a good thing. Now you can deploy those people into more valuable areas, okay? And this comes down to efficiency. And let me stop here for questions. And did I run over? How'd I do?
So you ran over by 2 minutes, which, to be honest, is
Oh, no.
spot on. That's perfect. Listen, Warren.
Okay.
Go on, sorry, go on.
Yeah, no, I'm good. I'm listening.
Well, Warren, listen, thank you for that. That was really, really, really excellent. And it's, I'm sure we're going to have a lot of questions now from the audience, those who are both economically minded and those who are maybe less economically minded, either way. So what we're going to do is we're going to take turns between the chat questions and the actual questions from the audience. So what we'll try and do is can everyone see the reactions button? If you can do the clap emoji, that can help me show you want to raise your hand, essentially, to take part in the discussion, to ask a question. So, Jamie, is that how it works? So you click on a reaction, you can raise your hand effectively?
Yeah.
Yeah. So if you click an emoji, like a reaction emoji, I'll indicate that as you wanted to ask a question. And then you'll be unmuted unless you can unmute yourself. So what we'll do is, I'll probably start in, Jamie, do I have permission to start in the chat for one question?
Yeah.
So we'll go random. Okay, so Warren, question from Kevin Clark. How will small businesses, such as a cafe owner, manage to pay equal to the job guarantee wage, which should be the living wage?
Okay, so it's going to be a policy option of where you want to set the job guarantee wage. You could set it at a level that's non-disruptive to start with, okay? And you have to decide whether you want, what you want to, this thing's going to function as a minimum wage, like you said. You have to decide whether you want cafe owners to have to pay higher wages, and therefore people will have to pay more for what they pay in cafes. So do you want cafe employees, what standard of living do you think somebody working in a cafe should have? So these are all political questions. And what we give you is a institutional framework to be able to directly answer those questions and then directly implement a policy that promotes public purpose.
Okay, we're going to have a question from the audience now. So if people want a question, can you please click on the emoji reaction, and I shall pick someone at random. You don't have to have your camera on. You can, as long as we hear you speak. And please make the question short as well. So if you want to ask a question from the audience, please click a reaction emoji. I don't know if I can see any. Hold on. This is working. No question from the audience. Interesting. Okay, we'll go back to the questions.
Well, there's nothing controversial, right?
No, we've got tons of questions in the chat, so that's fine. If you don't want to ask in person, that's fine. What you can do is you can privately message me if you don't want to do it publicly, and I'll do it anonymously for you. We'll talk about, actually, there's been 2 or 3 on foreign reserves. So what about so Warren, talk us through foreign reserves. Would an independent Scotland have to build up sufficient foreign reserves, in order to function a floating currency, or is that less necessary with a floating currency?
Yeah, I don't think you do. I mean, if you look at today's countries like the UK, they're not using foreign reserves to function anywhere. I mean, they did in the past, and it didn't work out so well, right? With the all those fixed exchange rate agreements they had. So what you would want to do is you want to have some strategic stockpiles of foreign reserves in case of a war or something where suddenly foreign trade, there's some problem where the U.S. won't sell anything except for dollars, or the UK won't sell anything except for sterling. But I'm not. Are your exports decided that exports from Scotland caused cancer, and now you can't import, what you need to run. So you'd want to have some foreign exchange as some kind of strategic reserve, the same way you'd want a strategic reserve of food stockpiles in case there's a famine. But beyond that, I don't think you need foreign exchange to function.
Okay. I got a question here from Graham McCormick. He asks, how will how will globotics affect the job guarantee scheme, possibly reducing human jobs by 60% by the movement towards a standard working week of 30 hours or less?
Yeah, well, that's a good thing, of course. That's an increase in productivity. And that's what makes us all better off. So 200 years ago, we wouldn't have been able to hold this meeting because we'd all be working in the fields to bring in the food. We had 99% of our people employed in agriculture. And today in the US, it's less than 1%. And we're a large exporter of food. So we didn't create 98% unemployment by shifting everybody out of agriculture. We shifted into other things so that we could have other things, such as manufacturing. And now manufacturing's down to 7% of US employment, something like that. So over 90% of employment is in services. So what you're doing is displacing, it's the amount of jobs you can displace in that remaining, let's say 10% that's doing manufacturing and agriculture it's minimal. But so all the jobs are in the service sector. And the service sector have turned out to be the most important jobs that pay the most and allow for this kind of meeting over the internet with all the software that people have spent all the billions of hours writing so that we can do this, and all the public health advantages and all the medical advances and all these researchers all over the world coming up with COVID vaccines and all their assistants that bring them lunch and whatever else they do. You can't have all of those if everybody had to be in manufacturing and everything else. So we need these productivity increases. Do they create unemployment? Well, in the first instance, yes, but unemployment is always a monetary phenomenon. It's people looking for paid work that can always find paid work if there's money out there to pay for them. So, and you can create that, what we call aggregate demand, by lowering taxes and have transition jobs so that these people are employable, or increasing your public services. So for example, if university professors were allowed to hire research assistants without limit, how many unemployed would they absorb? Quite a few. If the nursing homes were allowed to hire people without limit to, hold hands of your parents and tell them stories all day, there's a lot of things people can do. And so if we can have robotics doing things that free people up to do things that we recognize as more important enough to do, we can do that. Or we can have more leisure time, if that's considered a benefit. Now, for Americans, that's a horrible thing, but for Europeans, leisure time's a good thing. So it depends on your culture, right? So what happens is people confuse an unemployment story with a productivity story. You don't want to do that. We don't want to outlaw lawnmowers, so we cut all the lawns with scissors so there's more jobs. That's not what it's about. We want as many robots as possible to do as many jobs as possible so that we free people up to do other things. Let me put it one more way. There's always more to do than there are people to do it. Every morning we wake up with 100% labor shortage. And so if you ask anybody, how would you like to be given enough money to hire a personal assistant to help you with your life, take care of your emails and sort out your pictures and help you with the shopping and do everything else? Maybe you can read a book if you want during the day or take a nap, help with the children in your business. Research assistants everybody would say, yes, we would like to have a personal assistant. Well, if you gave everybody the money to hire a personal assistant, how many personal assistants would there be? Zero. Who's going to be the personal assistant if we all want one? Nobody, right? This is a fallacy of composition, right? So every day there's a massive labor shortage. Life is about more to do than there is time to do it. And it's become the reverse only because we've lost our understanding of the currency the way everybody had it some 200 years ago, in human history. We've lost it and created this horrible reversal where, that's got us where we are today.
Great, thank you for that, Warren. I've got two more questions here. This is from, we've got one from Lynn Dugan, and after Lynn, we'll go to Kathleen. We'll go to Lynn first. From my hubby in the background, would the Bank of England have to agree to a 1-to-1 ratio, pound to kill? What if they disagreed?
Well, they have no say in the matter, and they don't care. You know, you're just saying my tax liabilities are no longer going to be sterling; they're going to be killed. So they're going to lose people's desire to save sterling in Scotland. It's not going to make sense. People are going to start accumulating kilt to have money in their pocket, cash in the cash register. So, you know, that's kind of a loss of seniorage, but it also means the UK public debt will be that much smaller. So they'll probably think it's a good thing, okay, because they've got it backwards. So the question is, when you ask me if they're going to care, do they have it the right way around, the MMT way, or do they have it backwards? So the way they have it backwards, they're not going to care at all. And even if they had it the right way around, they probably wouldn't care anyway. But if you start your country, you know, independent country, and you say, look, all these tax liabilities, instead of sterling, they're going to be in kilt. And here's your new tax liability. I mean, that's to be expected, right? That's not, what do they care if it's a 1,000 sterling tax liability turns into a 2,000 kilt tax liability, or 500 kilt, or no tax liability? It's not their concern anymore. It doesn't, they could care less. They're looking in a different direction. It's not on their radar. It's not an interest to them.
Now from Kathleen, she asks, how would MMT dovetail with environmental constraints?
Yeah, so, and I'm not sure you'd call this MMT, but it's me, so in that sense, I guess you can call it MMT. Look, we've just cut environmental degradation by something like, depending on where, 20, 30, 40, 50%, by eliminating what have been called non-essentials. That's called conservation, right? Now, a year ago, I was saying we can make massive progress, maybe up to 50%, just through conservation. And everybody's saying, no, you can't do that. Well, we can do it, and we just did it. So now we're trying to come up with a way to reset, to restart our economies. Well, if these things that we've lost, this consumption that we've lost is non-essential, why would we want to resume non-essential consumption at the cost of resuming the environmental degradation? We just made more progress on the environmental side than we probably would have made under any Green New Deal in 30 years, you know, in 6 months, by eliminating non-essentials. So what we can understand is that we can restart in directions that only don't increase the use of the environmental degradation, but work in reverse through careful management and without jeopardizing like jobs and well-being. Because we all, if you just, the production of essentials has not suffered. There's no shortage of food at the grocery store. There's no shortage of anything. There's surpluses of things, even without 20%, 30% of the workforce not working. Massive labor supply shock has not resulted in any shortages of anything essential. So this is like an enormous revelation of how we can now move forward, let's say, for free, right? We can move forward, you know, with less environmental degradation and declining, with a massive cut in environmental degradation and declining degradation without what we would consider in the past the massive cost of getting there. Okay, by continuing to move in this direction. So I'm not sure if you call it MMT, but I feel like I've been alone in talking about this. And maybe it's because you need to have an understanding of the monetary system to be able to like come to that conclusion. So I'm not sure you do, but that would be the only way I could tie it into MMT.
We actually have a almost a discussion going on in the chat bit, but before we go to the chat again, I'm going to get a question from Twitter. This is a question from a guy called Ross. So Ross came to me and he asked, a question I have is, what would happen if mortgages denominated in the UK pound following independence and the Scottish pound?
Okay, so nobody is involuntarily converted. So however, if you've got a sterling mortgage and you're retired and you've got a sterling income from the UK pension fund or something like that, you can leave it in sterling because that's your income, that's your expense. You know, you feel comfortable with that. you don't want to switch it to a kilt thing because then something happens to the exchange rate, you're at risk. If you're a government employee or you're working in a shop or whatever, now you're getting paid in kilt. Oh, excuse me. Then you might want to convert your mortgage from sterling to kilt. Okay. Well, today you can convert your mortgage from sterling to yen if you want. If you move to the UK and you're from Japan and you get a mortgage in sterling, you can get a mortgage in yen if you want to. So it's nothing you can't already do. At the more sophisticated banks. And I'm not saying every local bank offers that service, but you would offer that service. I would offer that service, and you do it at market levels based on the going exchange rate. And initially, the going exchange rate is going to be 1-to-1. So if you came in to do it with your local bank, the new Bank of Scotland could facilitate that at 1-to-1 as long as the sterling, that is the actual market ratio. And now, but I can give you all the reasons why that's going to remain 1-to-1 with kilt trading at a slight premium, maybe a 1% premium for the initial transition period, which might be 3 to 6 months. So does that answer your question? So what you do is you go into your bank, you say, I don't want my mortgage in sterling, I want it kilt. He says, okay, we have to do an FX swap or something like that, which you don't care about, but he does on his books. And they have amortizing swaps that amortize at mortgage rates. They have, and this central bank will take the other side because they have the kilt and they have use for the sterling assets at the moment. So it's no problem to them. And so then you just give them the paperwork and you say, okay, you now owe us kilt instead of sterling. Your balance is now 200,000 kilt instead of 200,000 sterling, or maybe it'll be 199,000 kilt, or maybe it'll be 201,000 kilt. It'll be very close.
Brilliant. Okay. Thank you for that, Warren.
Yeah.
We've got, I think, now I'm probably going to butcher his name, but Gonzalo Martinez, did you want to ask a question? Because I think I can't see I don't think I can see the emojis for some reason, and Jamie's camera's going off. Jamie, can you unmute? Oh, wait, I think Gonzalo's already unmuted himself. Gonzalo.
Yes, thank you. My question is the following. If you find that you have unemployment, your recommendation would be to lower taxes. What kind of taxes would you eliminate? Income taxes, labor taxes, consumption? Which kind of taxes would you eliminate first?
Okay, so you would have your choice, but I'm a progressive economist, so I would eliminate the most regressive tax first, and the taxes with the highest compliance costs. But don't forget, if you have unemployment, you have your choice. The public sector can hire them to increase public services, or you can lower taxes to send them back to the private sector they're going to be in the job guarantee. So what you're saying is not that you have unemployment, it's that the people in the job guarantee, you have too many people in the job guarantee. You want to keep that at a minimum, maybe 1 or 2%, just to handle frictional changes in people's lives. And if it gets higher, if it starts creeping up to 3 or 4% because of some weakness in the private sector, then you want to either increase your public sector, which you may not want to do, or you want to get them back in the private sector. So you lower taxes, which would increase aggregate demand, transition people back. So do you have a value-added tax there? Is there a value-added tax in Scotland?
Yeah, yes, we do, 21%.
Yeah, I would. I don't think it's a bad idea to start by eliminating that, because that's highly regressive, right? It hurts people with the lowest incomes the most. And if you want to limit consumption, do it some other way. Don't do it through rationing through price at the low end. The value-added tax, have other use other methods to ration rather than price for food and essentials like that. So I don't know the details of your value-added tax, but to me that would be a target. It also has very high compliance costs. You have to keep records, and there's a lot of record-keeping expense. All those people who would no longer have to do that would be freed up to help cure cancer or whatever, and you could redeploy them into something more valuable. And also, it undermines the morality of the country, because there's a massive incentive to cheat on value-added tax. People use Bitcoin so they don't have to pay value-added tax. So you get rid of that incentive to be immoral, let's say, and be a tax cheat. And so personally, that's the kind of thing I look at. But again, it becomes your own internal political decision.
Brilliant. We've had two questions, one from Twitter, one in the chat just now. I'll just go for John Lack's question. Is there any way external parties, and by parties meaning countries, could destabilize and use Scottish currency? And from the question, again, from a guy called John on Twitter as well, actually, he asked the same question, but he asks, if so, how can independent Scotland defend from that? With assuming we have a free-flowing currency.
Yeah. Well, you wouldn't want to think in terms of destabilizing your currency because it's internally stable. So what you think of is your real terms of trade might turn against you. You know, they might decide Scottish whiskey is, ban it in other countries, put on big tariffs or something like that, because they don't want you to export as much, and that would affect your ability to import. So you'd have those issues, and they can be dealt with as you want. You know, Scottish whiskey could go out of style. So if that's an important export that's supporting the country, then you want to make sure you have a public effort to establish and maintain its desirability overseas, and make sure your embassies are set up to the embassies that you have. I don't know how many you have, but strategic places to support those types of things. Also, domestically, you want to make sure that strategically you make sure the supply of malt is there, so you don't get shortages where are going to hurt your industry. You want to make sure you have strategic stockpiles so you don't run out, so you can stabilize costs for your exporters. And you want to let them all work together in concert to export, because collusion like that gets you better prices. And since you're selling overseas, you want Scotland to have the best possible terms of selling and exporting. You want to make sure the marketing, if as possible, as much as possible, and it's voluntary, of course, but you offer ways to have it coordinated to optimize your well-being. And same thing with your imports on the other side. You want to make sure you're importing as efficiently as possible. And I'll give you an extreme example, but you import a lot of automobiles. So rather than have 20 different brands that you're importing, maybe you could go to one brand who builds most of the models that people import and say, look, would you give us a substantial discount if we limit imports of new cars only to your brand? You know, that way you could increase your volume and whatnot. And then you'd be getting your products for everybody cheaper. So, and then you'd make all the companies compete, and the lowest bidder that offers you their automobiles and service at the best price would be allowed to sell cars. And that would reduce their sales and marketing expense and give them more efficiencies to get you an even lower price. And that would be the benefit of everybody. Now, I know people want choice in automobiles, so I just use that as an example. But there are other things where you can make sure you're organized when it comes to importing to make sure you're getting the very best possible terms possible to be able to import.
Right. Thank you, Warren, for that again. There's quite a lot of questions coming in. I'm trying to keep track of the ones which I promised I was going to do. Okay, so I've got one from, we'll do Colin K, then we're going to go to Karen Van Sweden, and then we're going to go, we'll take it from, let's go to these two first. So Colin McKay asks, or says, the Scottish state itself does not really own that much or have that much cash, I would assume. Now, because the Scottish state right now is, of course, devolved as it is currently. Most things in Scotland are privatised. How does Scotland build up what's required to exchange for sterling in the first place when trying to build up kilt? Okay, so the sterling, if somebody wants to export to Scotland, which they all do right now because, the exporters are in control of most of these nations of the world, and they actually export at the expense of the macro economy. Some export below cost. Imagine going to a store and they're selling it below cost, and you file a complaint saying the store is breaking the law. They're selling me groceries too cheap. But that's what these nations are doing, right? Now, the U.S. is complaining that Canada is selling us lumber too cheap. So you've got all these exporters, whether it's Canadian lumber or Japanese products or Chinese products, that are willing to actually sell below cost to get things to you. And they sell in exchange for the local currency. They'll put things on sale in kilt, and then they know what the exchange rate is. Then when they get the kilt, some of it they use to pay local expenses, some of it they
will actually save as reserves, and the rest they'll sell to get the currencies they need to pay their local expenses, their payrolls locally in China or Canada or anywhere else. And that could drive down the value of the kilt versus the Canadian dollar, for example. And that's kind of the question you're asking. So you've got a couple of things that happen to your advantage. Number one is these countries like Canada and Japan, like not Canada so much, but Japan and China and Korea will actually go buy the kilt from the manufacturers because they want to be competitive and net export to Scotland. They don't want to buy import because their exporters are in control. And if they exported everything and everybody died, they wouldn't care because they just want their profits. Whenever exporters are in control, the macro economy suffers from it. And so, you've got that working to your advantage where you probably have the kilt be put into the JP Morgan index of global currencies in some weighting based on population, in which case it gives these central banks an excuse to accumulate it to support their exporters, and it gives all their investors a reason, and they automatically accumulate it so they don't underperform, and it allows you to import. Okay, and so without having to export anything. So it allows you to have net imports. So number one, you're going to be ahead with that. And that's how the UK net imports, because sterling is held in all these portfolios all over the world as net financial assets because they're in the JP Morgan World Index, because China wants to export to the UK. They buy so many sterling, same with Japan and Korea and all these major exporting countries. And the oil exporters too. The rulers in those countries don't want to hold their local currency. They want to hold foreign currency. So that allows you to net import also. So but to the extent that they don't, then they are out there selling kilt to buy their local currencies back to meet their payroll. On the other hand, your exporters are getting paid in foreign currencies. They're selling to England, they're selling financial services to London, they're getting paid in sterling. They're selling the sterling to buy kilt because that's how they have to pay their people in Scotland. So you've got a back and forth in that currency, and that's what the market, that's what the foreign exchange market is. And to your advantage, you've got foreign governments and foreign vast portfolios will be accumulating kilt as part of their diversified investment strategy, allowing you to have net exports, which is a benefit. You want to make sure you see that as a benefit. Don't try and kill the goose that's laying the golden eggs.
Okay, thank you for that, Warren, again. We're now going to go to Karen Van Sweden. I don't know if Karen, if you can just unmute yourself, or Jamie, if you have to. Oh, wait, Karen, get to unmute yourself. So, Karen, ask away.
Hi, Warren. I wanted to know how you rate the ratings agencies.
Oh, I've talked to them over the years, and I thought I was getting somewhere. I talked to a guy named Chamberlain or something at S&P, and I talked to him, and it's been a long time. And they agreed on the distinction between ability to pay and willingness to pay. But they don't make that clear. And they agreed on ability to pay a country with their own currency. There's not a ratings issue. And that was S&P I talked to. Willingness to pay is a different thing. So in 1943, Japan owed the United States government yen and didn't pay it. Now, they had the ability to give them the yen, but they didn't want to do it. And you can understand why. And so you've had, in 1998, when the Russian ruble broke down, and what happened was everybody in the central bank just went home. They didn't even shut off the lights, so the payment system stopped for a while. They had the ability to credit accounts with rubles, but they didn't have the willingness. They just all ran out of the central bank and stopped pushing the buttons. So you can get a default in somebody who has the ability to pay, but not the willingness to pay. You look at our president, Donald Trump, didn't pay people who worked for him. Well, he had the ability to pay, he just didn't have the willingness to pay. So the rating agencies do understand that in their analysis, but I don't think this latest downgrade of the UK, they specifically said they were basing it on willingness to pay, which they should have if that's what they were going to do, because they certainly can't downgrade it on the ability to pay.
Brilliant. Thank you, Warren, again. We're now going to move to, I need to find questions again because people are chatting quite a lot. I'm liking it, though. I'm liking it. Okay, so I'm going to go to Joseph McMahon. He's giving a quote from a newspaper in regards to the Scottish First Minister's advisor, Andrew Wilson. Now, I think you'll be aware of Andrew Wilson, Warren, as was mentioned in one of the other talks you gave when you came to Glasgow and Edinburgh. The quote is, Wilson told the paper that a new Scottish pound could be achieved in, quote, 5 to 10 years. Is that a reasonable / appropriate timescale? And just as you answer that as well, we're going to move to Timothy Rideout after you answer that, because Timothy's got a bit to say on that too. So we'll go to you, Warren, to answer that question, and then we'll go to Timothy. Warren, your view on the 5 to 10 years timescale for a new Scottish currency?
No, you're talking about at most 30 days. Okay, all you have to do is get one of your local banks, which already have accounts in sterling and yen and dollars and whatever, to just add a line to their spreadsheet for Kilt. And then you contract with them to be the central bank until you set up your own spreadsheet. Or you just leave it. You could just contract with them to be your central bank. And then in Kilt, the various accounts. There'll be accounts of the other local banks that are under regulation. And they have to open up accounts, so they have to have the paperwork, and the people at the bank have to sign papers to open up a Kilt account at the correspondent bank. Maybe the guy's wife has to sign. I don't know what your rules are over there. But once everybody signed the account documents, it takes no longer than it takes for to open up an account now. If I moved to Scotland and wanted to open up a dollar account at one of your banks. So I don't know if that takes a few days. And then the banks would then offer those accounts to their clients. And you might want to wait until 30 days, only because that's how long it would take them to get all their clients online and have all the paperwork signed. But you don't need any more hardware or software than that if you're willing to have one of the local banks act as a correspondent for the central bank. The central bank then doesn't even have to have a computer. It'll need a computer to be able to read what the other bank has on its computer, but that's all it's going to need.
Okay. So just before I go to you, Tim, I just want to read a comment from Lorraine Cowan. Andrew Wilson has very little knowledge or imagination in these areas. Tim Rideout would be a much more effective advisor for the First Minister. So Tim, first of all, what is your reply to the original question? And second of all, would you accept a job offer of becoming Nicola Sturgeon's advisor on setting up a new Scottish currency?
Of course, well, why not? I mean, if you need to have a look at the National tomorrow morning, because you should see my reply to the interview with Andrew Wilson. Now, interestingly, I mean, I've maybe asked Warren. Andrew Wilson is not a fan of MMT, and in fact, he had a rather gratuitous attack on MMT in his weekend paper article. He said that MMT was a dangerous lie that involved printing money. So what would you say to that?
Well, I would say he doesn't understand monetary operations. And I don't know if he's tried to understand them, probably has not even tried to understand them. So he's just relying on, headline rhetoric. Oops. And not on any, look, all MMT does is tell you when the central bank spends, it credits an account. When it taxes, it debits an account. I don't know if that's a dangerous lie or what it is, but anybody in monetary operations knows that. And this is all just just is grounded in just central bank clearing. So I don't know. I'd have to say he either has, I give him the benefit of the doubt and say he hasn't read it or understood it, or else he's just, lying. So you tell me which. It's what we call innocent fraud, right? Like my book. By the way, Tim, I saw you down there on the list, and I'm thinking, why aren't you giving this presentation? What do you guys need me for?
Tim gave a presentation last year. It was very, very good.
Oh,
sorry to go on there.
Yeah. Okay.
No, I have emailed Andrew Wilson. I have told him to go and read Stephanie's book. I've sent him loads of articles. He obviously hasn't read any of them. So,
right.
Yeah.
Well,
Yeah.
we're going to move on.
Well,
Go on, Warren.
yeah, let me just say every Bloomberg article, every article on CNN, everything, every Guardian article starts off, well, MMT is where the central bank buys the government bonds and monetizes it. That's not what it is. In fact, we'll be the first to tell you that's just a placebo. It doesn't do anything. I would never recommend that as a policy. It's just a wheel spin. It's just a waste of time. You can just use normal deficit spending without any of that. It won't make a bit of difference. But if he got his information from those sources, he's going to have it wrong.
Thank you for that, Warren. Again, got two questions there, but I'm going to touch on a question which has been asked pretty much everywhere, and I think it's almost a universal question which you might get a lot. So, kind of discussing modern monetary theory or just basic banking operations, central and private banking operations, to the average individual, it flips their mind on, flips the table in their mind on how economics actually works, and usually they can either embrace it or they might immediately sort of reject it, or it might kind of take time. So the general question to you, Warren, is how do you explain MMT, especially in regards to Scottish independence, without spooking the horses, as some have said? So how do you kind of discuss it without kind of scaring people off?
Right. Well, the number one thing you can talk to people is that every member of parliament has the sequence backwards. He thinks he has to get Stirling, this is British Parliament, to be able to get the money to spend. What he doesn't get from taxing, he has to borrow. I'm sorry, I thought I had shut this off. I did shut it off. What he doesn't get from taxing, he has to borrow from China and leave the debt to our grandchildren, that type of thing. You say, look, that was true under a gold standard or fixed exchange rate, but things changed, and now they've got the sequence backwards. With today's monetary operations, the government has to spend first, and then taxes can get paid. The money comes from the government. They have a monopoly on that. And you could say, look, it's just like the football stadium. They don't like collect the ticket first and then sell it. They sell the ticket first and then collect it because it comes from them. So everybody understands that. Everybody used to understand that about the money. They've lost sight of it. It's got turned around, and they've got it wrong. And that's what modern monetary theory tells you. So it's about sequencing. And they have to spend first. Some gets paid in tax, and then the rest, if those people want, can buy bonds. So when the government's buying bonds, they're not borrowing the money to spend. They've already spent the money, and they're giving those people an alternative place to keep it, an alternative account at the Bank of England. They can shift it from one to the other. And they just got it backwards. So there can't be you can't go broke. You can't run out of money when you're spending first. That whole concept just doesn't apply. So you start with that and see what you get from there. And I don't know if that's how people start with the explanation or not.
Thank you, Warren. We've got a question from Gonzalo Martinez. This is from a little earlier on, but I'm just kind of scrolling back up to find other questions might have missed. Just before I go into the question, emojis are not showing up for me. I don't know if it's showing for Jamie either. So if you have a question you wish to ask on video, please privately message me or just say in the chat, and then I'll jump to you. So and you can ask it more directly. So
let me just add something very quickly here.
Sure.
So if somebody asks a question, how are you going to pay for it? You say, well, the money comes from the government. They spend the money first. They just credit the account. That's how you pay for it. Well, where does it come from? Well, they just change a small number to a higher number in your bank account. It's just scorekeeping. The same way numbers on the scoreboard come from. Where do they come from? That's just how it works. It's just, they're the scorekeeping. Okay, go ahead.
So from Gonzalo, he asks, state workers usually have unions, prevents them from competing for state jobs. How does that affect the transmission of the price level when government spends? Thank you. So that's from Gonzalo.
Okay, so how does that work? I don't understand how your system works.
So here in Argentina, state workers have very powerful unions that prevents the state from like firing them, right?
Yeah.
So how would that affect the transmission of the from the public spending to the price level when it spends, when and pays
Yeah.
salaries to them.
Right. So I don't know about now, but Argentina used to index those wages. And
Yeah.
so and the index would be kind of politically determined index. And so when they gave everybody the increase, they were redefining their currency downward. That would cause the inflation. And there was a Latin American economist, I think his name was Prebisch, and I remember a statement that all the Latin American inflations could be traced to indexation. And when Argentina went off of the fixed exchange rate in 2001, right, 32 dead in the street, when it was a pretty severe situation, the inflation, when they floated the currency, right? Well, before that, when they went on to the fixed exchange rate, was about 10 years before, the inflation stopped. But what also happened is they outlawed the indexation. So indexation was outlawed when they went to that, when the peso was fixed to the dollar. So that's why that problem got delayed for a long time. So what you have to do is you recognize the source of inflation is the prices paid by the government. And if you want to accept that, that's fine. There's nothing like immoral about inflation. Inflation isn't going to hurt your economy. There have been studies done that show inflation's where they studied inflation rates up to 40% and showed that they did not affect output employment negatively or anything else like that. But people didn't like it. They consider it the government robbing your savings, whatnot. So it's a political problem. It's not a real economic problem. So if Argentina has this structural reason why inflation is going to be 6 or 8% or 10% or whatever because of this indexation, then that's what it's going to be. If you want to change it, you're going to have to change that policy one way or another. It doesn't mean, but once you recognize that as the cause of the inflation, then you don't raise interest rates to fight it because that makes it worse. So you're sitting there with what was not long ago a 35% interest rate, which was exacerbating the inflation caused by indexation. You come up with policies to put people out of work to lower aggregate demand. It's not going to work. You're still going to get the inflation, but you're going to have unemployment. You're going to have high interest rates that are giving basic income to people who already have money, which exacerbates a huge distributional problem you already got. And you're not going to fix your inflation problem. Those things, you're giving it the wrong medicine that's just making the patient worse and not curing the problem.
Brilliant. Again, thank you, Warren, for that. We're going to go to a question to John Leck. This is just recently. As we know, selling bonds is a monetary operation to control interest rates and is and is not advocated by MMT. Where would large companies save their cash, i.e. pension funds, etc., in an independent Scotland if bonds are not issued?
Look, they put their money in the bank. Their deposits would be insured up to however much they put in. So if they've got $100 million in bonds, they'd have $100 million in a bank account that's fully insured by the Scottish government and killed, and that would be a bond. I mean, that's what their bonds are now. They're sterling. They're guaranteed by the Bank of England. They're deposits at the Bank of England. Instead, it would be a deposit at the Bank of Scotland. At the branch of the Bank of Scotland, one of the member banks of the Bank of Scotland, fully insured. So it simplifies the whole system. There are no bond traders. All those people can go out and cure cancer. They're very smart people doing all these financial transactions that you'd have freed up to write software and do all kinds of useful things rather than what they're doing now, which can be seen as just digging holes and filling them in.
I'm going to ask a question, if that's okay,
Yeah.
Warren, and I think it's something I discussed with you recently, and it's been an interesting point in debate around the Scottish currency. So obviously Scotland has a trade deficit, and in your eyes, of course, imports are of real benefit, and at the same time, we're deficit spending at the same time. So it's kind of an outflow of, say, the kilt going into the world. At the same time, the argument is that large companies can borrow in mass. Large companies can borrow with a lot of capital, the Scottish kilt from banks, and essentially the argument is your model would effectively, although it's biased towards appreciating the kilt because it's about building demand over time, because companies can borrow a lot of kilt, the new Scottish currency, in large amounts very quickly from the private banks, that would go against what you're proposing, and actually the new Scottish currency will depreciate. So how would you respond to that point, in that private people can borrow from private banks and borrow large amounts of kilt, which could and with the trade deficit in mind as well, which could depreciate the new currency.
Well, why would his borrowing depreciate the currency? It would only depreciate it if they then sold what they borrowed for sterling. Then it would depreciate. So you're saying they're going to borrow kilt? They're going to borrow kilt and then use it to buy sterling?
Oh, this is not my argument. I'm just giving a general.
Oh yeah.
It's
so the argument's incomplete.
Right.
Yeah, the argument's incomplete. Just borrowing doesn't cause a currency to do anything. If the man in the moon borrowed, $1 trillion kilt and left them in his bank account, then nobody would even know it. It wouldn't affect the economy at all.
Okay. We're gonna.
And look, the amount of money in the banks doesn't affect anything because loans create deposits. So lending is not restricted by the kilt. And also, kilt don't leave the country. They'll still be in the bank account. The name will just change from, from somebody's domestic name to some foreigner's name. So, it'll go from Joe to Jose or whatever, but the kilt just stays in the same bank, in the same bank account.
Okay, thanks for that. One question I've had, actually Malcolm's raised his hand, so I'm gonna give Malcolm the chance to ask a question. I don't know if you can unmute yourself, Malcolm, or Jamie, if you'll have to unmute Malcolm, either way. Malcolm, you can ask a question.
Can you hear me?
Hi.
Okay. Hi, Warren. Just a quick question on the talking about inflation. How does the assertion that the price that government pays for stuff cause inflation, how does that transfer to hyperinflation, or does hyperinflation, does that have different or additional causes like exogenous external shocks?
Yeah, so in fact, I just did a paper with Phil Armstrong on Weimar. And look, hyperinflation means prices are going up. If the government says we're not going to pay it, then government spending goes to zero, right? Because all the prices go up. So if the government spends on a price rule, and the way the textbooks used to talk about it was you can spend on a price rule or a quantity rule. If you're a monopolist, you spend on a price rule. So if the government says, look, I'm not going to pay a penny more than what I paid last year, and all the prices go up, government spending goes to zero. Right? So now that you have all these tax liabilities and no way to get the money to pay the tax except to lower your price to government. So you set this, it's like an automatic deflation. Now, I'm not saying it would be good policy to do that because it'd be a horrible deflation if that happened. It might politically make more sense to pay an extra 5% and not worry about 5% inflation. But if you are price increase, increase the price level. But until you decided to pay the higher price as government, that price is coming back. It's not going to keep going up. So can I give you an example there? Let's say New York City used to have subway tokens to ride the train, and they were $2 each. So there could be a shortage developing of people rushing to the train. They're late. They're buying them from other people. They drive the price up to $3 or $4. Okay, but if New York City keeps selling them at $2, the price is going to come back down, right? And vice versa. So there might be a glut of subway tokens, and the price, people start selling to each other because they don't want them anymore, which would be inflation. And the price goes down. So New York City just doesn't sell any because the price is lower. Well, people keep riding the train, and sooner or later they're coming back to get them at $2. Mm-hmm. So they're setting the price of the token at $2. It's going to get there, one way or another. It doesn't mean that they won't. If you're in a poker game at 3 o'clock in the morning and you lost, and all you have is subway tokens, they might only give you $1 for them. Right? So it doesn't mean that every subway token in the private sector is going to trade at that price. So it doesn't mean every kilt everywhere is going to trade at the exchange rate. But it does mean that over time, in a relatively short period of time, you either have to come back to the government to get it, or if you have surplus and the government that's driving up prices and the government doesn't want the higher price, that's government as a source of kilt is going to dry up. And so that's monopoly. And if you go through all the textbooks that ever described how a monopoly works, since the beginning of time, it's described, this is first year microeconomics. So there shouldn't be a lot of dispute over that monopolists are price set. It's not a competitive situation.
Yeah.
Thank you, Warren, for that. Well, Malcolm, do you want to follow up with a question on that, is that okay with you?
Yeah, it's going to take a bit of thinking about it, because we're always given the various causes of inflation in Weimar, Argentina, Venezuela. But and there's always foreign denominated debt, poor policy choices, unemployment, and various things like that. But actually coming back to this root cause, I've now got to kind of unpick that and try and fit it into the picture where the government is actually part of the picture.
All right, so
paying the higher prices.
Let me do that for you. Let me do that for you with Weimar. So they had war reparations, which were like, they had inflation. Then they had they were increased in 1922 or something. It went way up. And I think the deficit spending was something like 50% of GDP. It was huge. And the government had to sell marks to buy francs to pay France, sell marks, buy sterling, sell marks, buy gold. And so as the price, when they sold the marks, the value of the mark would go down. And they would then sell more at that lower price of the mark, or the higher price of the franc, right? So the price of the franc goes up, they buy more. The price of the franc goes up, they buy more, because they had to for war reparation. They back off, and the French army goes in and takes over the coal producing region of Germany, to get the coal themselves, because they weren't happy with the monetary payment they were getting out of Germany. All right, but it was them paying higher and higher prices, in that case for foreign exchange, and with the rest of the inflation coming in through the FX window, all their imports. They have to import a lot, critical things, because their economy wasn't producing, right? But it was largely through that. Now, in 1923, when that policy stopped, that spending stopped, the inflation ended, went to zero with the new Rheinstadt, or whatever the new currency was. And the other interesting thing was, as they had their hyperinflation going, the demand for banknotes for transactions went way up.
Yeah.
And so just for cash to buy a newspaper or something, you needed to have this stuff. They didn't have credit cards. Okay, so their printing presses, the government printing presses, couldn't keep up with it. So they subcontracted out the right to print money to these other companies, and apparently didn't limit the amount they were allowed to print. And so there was more deficit spending. They didn't care what the prices were people were paying, right? Yeah. And so that was what they call that a government's agent was given license to print all you want. So anyway, they stopped that. And all these emergency measures they took, they called it emergency money. All the stuff they did stopped, and the inflation stopped, and that was the end of it. So when they stopped paying the higher prices for foreign exchange, for everything else, then the inflation stopped.
I think the governor of the Reichsbank at one stage in 1922 boasted that they had enough printing presses to be able to double the currency every 5 days.
They still subcontracted emergency money out to other printers.
Okay, we're going to go with, so we've got one question here, Warren, from John. I'm going to butcher the second name, John Metcalfe. I hope I pronounced that right. John says and asks, surely interest rate is controlled by the central bank, not by selling bonds. A government selling bonds is just mopping up already issued money in the economy that is sitting primarily pension funds and giving the pension funds a risk-free investment.
Yeah, well, like we talked about with Kilt, the alternative to bonds would be overnight deposits. So bonds can be thought of as time deposits of government versus overnight deposits. So it's like a bank would have checking accounts, which are overnight deposits, transaction accounts, and they'd have time deposits or savings accounts, which are a little bit long, which can be any length, right? CDs, we call them. They have all kinds of names. So the bonds are just time deposits, and the other ones are overnight deposits. And when they sell bonds, people shift money from their overnight deposits to their time deposits, to the bond deposits. And so whether or not corporations keep their money in an overnight deposit or keep them in a time deposit it depends on whether or not there are time deposits. So if all the government offers are overnight deposits, and that's where they're going to keep that money. If they want to keep it longer term, they're going to have to buy corporate bonds or something else. They're not going to be able to get it from the government.
Just as we're talking about bonds here, actually, Kevin Clark has just asked, some of the talk is about government selling bonds at negative rates. Would businesses accept and buy these bonds? If so, what would that mean for government?
Yeah, so it's interesting because a negative 1% interest rate means if you started with 100 kilt, a year later, you have 99. That looks a lot like a tax, doesn't it? So it's a wealth tax. So we had Senator Elizabeth Warren put out the idea that there's going to be a wealth tax, which would include a tax on bank deposits of whatever 1%. I don't know what her percent was. Let's say 1%. And everybody said, no, you can't do that. It's a tax. It's going to ruin the economy. You know, you're taking money out of the economy. You're lowering people's wealth. It's a wealth tax. So we don't want to do that. That's bad. All right. Then the central bank says, well, to help the economy, we might have to go to a 1% negative interest rate. Well, it's the same thing, right? But that's good. But if the central bank does it, it helps the economy. If the Elizabeth Warren does it, it hurts the economy. It's exactly the same thing. Okay, it hurts the economy. In the European Union, with their 0.5% negative tax on whatever deposits are taxed, is taxing the economy. They're taking euro away from the rest of the economy, the private sector, and they're debiting their accounts. It reduces the net financial assets, the income in that sector. It doesn't make the economy stronger. It doesn't cause inflation. It doesn't do anything they think it's doing. And it doesn't hurt the euro because it's like fiscal tightening. So they've got it backwards. They've got the whole interest rate thing backwards. When they increase rates, they're paying out more interest to the economy. It's basic income for people who already have money. It's an inflationary bias. It's a fiscal spending, increases deficit spending, all else equal, of the state. And it's expansionary bias. So they've got it completely backwards. And the way I say it is, you know, they're lowering interest rates and they don't understand why its economy's not doing better. I compare it to the carpenter with a piece of wood who says, no matter how much I cut off, it's still too short. And you still see this in every central bank all over the world. And I don't know what to tell you. It's just, it's just what they're doing.
I'm going to ask one final question, if that's okay, because we're nearly hitting 9 o'clock.
Yeah.
So let's say the political will is there for your plan. Let's say that Timothy yourself, you become the advisor to Nicola Sturgeon, First Minister of Scotland. Scotland becomes independent and they go with your plan. So if your plan in place, do you see an independent Scotland going with the kind of policies you advocate in the long term, becoming a more equal and economically stable and potentially prosperous country in the long term? In your overall view, do you think that that's the potential an independent Scotland can have with your plan?
Yeah, I think it would be within 12 months. Scotland would be the most prosperous, nicest place to live in the world. I don't see any reason why not. I mean, you already know how to do it. You just don't know how to pay for it. So this tells you how to pay for it. Just write the check. It'll be okay. As long as you're not paying a higher price than you paid before, you're not causing inflation. And if you do pay a higher price, you're causing a one-time price increase. And if you don't think it's worth it, you don't want to do that, don't do it. Wait for the price to come down. So yeah, I think immediately Scotland goes to top of the list.
Before I pass over to Jamie again to kind of bring the meeting down, I just want to say that I'm kind of hijacking the meeting, kind of self-promoting the kind of MMT groups here, but for anyone interested in learning more about this sort of stuff, Timothy Rideout, who's just left the meeting just now, he's got a group. Oh no, he's here actually. Timothy right there actually. He's got his Scottish Currency group on Facebook. You can join that, ask questions, have normal discussions, and you can learn more about what MMT is there. You can also just join Modern Money Scotland. There's a Facebook group there too, where others will discuss specifically more on MMT and the wider macroeconomy as well. So there's two groups there, and there's also the Scottish Reserve Bank website. There's also the Modern Money Scotland think tank there as well. And finally, there's also, as Tim has pointed out in the chat, there's also Stephanie Kelton's The Deficit Myth, which has really blown up recently. But also, Warren Mosler has his own books, and the 7 Deadly Frauds, I do believe, is free online. So if you want to go read that, just search up on Google, and it should be on PDF.
And it's very short.
And very short as well. So that should be there for you. But listen, Jamie, I'm going to hand over to you,
Yes.
head of the society, to roll things down.
Yes, so I would just say a big thanks to Warren for obviously coming along and doing this. I know he's talked a lot about the MMT approach, and people were talking about the deficit myth. I don't know if people can obviously see that I'm holding up. The deficit myth. This book is honestly amazing. Stephanie Kelton does a really good job in kind of explaining it at a level that is inclusive of everyone. So it doesn't matter kind of your knowledge in economics. I wasn't extremely knowledgeable in economics, but after reading it, I just kind of, my mind was blown, and I understood everything a lot better. To the point now where I see people making weird arguments about economics and I can't help but cringe and think, no, that's not how it works. Especially when it comes to spending and people talking about the national debt. That's the one that annoys me the most. But yeah, it's a great book. Of like, it's you can get it on Amazon. I think Waterstones also sell it as well. And it's a great way to kind of, it really helps kind of wrap your mind around how spending would work if we had our own currency in an independent Scotland. Apart from that, I just say thanks for everyone that's come along. We are looking at doing more kind of talks in the future. I don't know what our next ones will be yet because they're not fully planned out. But I just like to say the information we put out on the talks are all on our social media pages at University of Stirling Students for Independence. On Facebook, on Twitter, it's Stir Uni Indie. But that's all from me. I want to say just thanks everyone for coming along, and I hope you've enjoyed it. This is recorded, so it will go up on our social media as well. But thanks everyone for coming along. Thanks Warren for doing the talk.
We'll also put
Thank you.
We'll also promote your book as well on our social media, just to show that you've highlighted that. So we'll put 7 Deadly Sins in our social media as well.
So look, Stephanie's book is a global bestseller. Okay, a book on monetary operations, and I think that has to make her the most influential economist in the world this year. You've seen all these countries, like the U.S. $3 trillion deficit, and not even a talk of a tax increase. Only after her book came out, only after people had some awareness. And the European Union is allowing 10 and 12% deficits. Who would have thought of that a year ago? Okay, so there's been enormous progress made, and she gets all the credit. And what other economist has had any influence over this at all? They've all been on the other side of this. So I just want to throw that in. It's just phenomenal that book is, and that Stephanie's achieved what she's achieved.
And also, you get a very good mention in the book as well, actually, because when she's talking about learning about modern monetary theory, it's a big part on you, actually, when she meets you at your home and you explain it to her. So, because you are one of the fathers of MMT, so there we go. Anyway, we're going to wrap up there. Warren, thank you so much for having a chat with us. That's
thank you.
Absolutely brilliant. I know it's a silent round of applause because we're all on mute, but there's one there for you anyway. But listen, we'll put stuff out there for in regards to what we all said tonight. Again, thanks very much, and we all hope you have a great evening. If you want more talks like this, please follow us on social media. We'll put in more talks like this. But apart from that, have a great rest of the night as well, folks. So do enjoy. Again, Warren,